Your bank is making more money from your savings account than you are, not slightly more. We're talking 10 to 20 times more profit from your money than they're paying you. They're doing it legally. Right under your nose, with your full permission. Every marketing message says save more, earn more, but you're not earning more, they are, every single day. Right now, there's over $11 trillion sitting in U.S. savings accounts earning maybe 0.4% to 0.5% interest. Banks are lending that same money out at 7%, 10%, even 25% on credit cards. The difference, pure profit, the biggest wealth transfer nobody talks about. From your pocket to their shareholders, I'm going to show you exactly how this scam works and what you should do instead. Here's a question most people can't answer. How much did your bank pay you last year to keep your money in savings? Not the percentage, the actual dollar amount. If you had $10,000 in a typical savings account earning 0.5% interest, you made $50 for the entire year. That's less than you'd make in 1 hour at minimum wage. But here's what your bank did with that same $10,000. They lent it out at an average rate of 8%. That's $800 per year in interest income for them. You made $50. They made $800 from your money, and that's conservative. They're actually lending your money for mortgages, auto loans, credit cards, and business loans at much higher rates. The average credit card interest rate right now is over 20%. If they lend your $10,000 to someone on a credit card, they're earning $2,000 per year in interest. You're getting $50. They're getting $2,000. That's a 40-to-1 profit ratio. And the best part for them, you think you're being smart. You think you're being responsible with money. Banks operate on a simple model most people don't understand. It's called the spread. They pay you as little as possible for your deposits. Then they lend that money out at the highest rate possible. The difference between what they pay you and what they earn is called the net interest margin, and it's pure profit. Right now, the average net interest margin for U.S. banks is around 3.5% to 4%. That might not sound like much, but when you're talking about trillions of dollars, that's hundreds of billions in profit, every single year. Bank of America had over $1.9 trillion in deposits as of 2023. Most are in checking and savings accounts paying basically nothing. They earned a net interest margin of about 2.4% in recent quarters. That's $45 billion per year in interest income alone, not from fees, not from services. Just from the spread between what they pay you and what they charge borrowers, while paying depositors almost nothing. Here's where it gets even worse. Inflation. Right now, inflation is running at around 3% to 4%. If your savings account pays 0.4% and inflation is 3.5%, you're losing 3.1% per year in purchasing power. That's $10,000 in your savings account. In real terms, after 1 year, it can only buy what $9,690 could buy last year. You didn't lose money on paper, but you lost money in reality. Over 10 years, if this continues, your $10,000 will have the purchasing power of about $7,400. You lost $2,600 in real wealth by being safe and keeping your money in savings. This is why your bank wants you to keep your money in savings. It's the perfect setup for them. Low risk, guaranteed profit, and customers who think they're being financially responsible while getting poorer. But it gets even more insane when you understand fractional reserve banking. This is the real magic trick banks use to multiply their profits from your deposits. Most people have no idea this exists. When you deposit $10,000 in your savings account, you think the bank keeps that $10,000 in a vault with your name on it, right? Wrong. They only keep a small fraction on hand. In the US, the reserve requirement was actually reduced to zero in March 2020. Zero. That means technically, banks don't have to keep any of your money on hand. They can lend out 100% of deposits. In practice, they keep some reserves for liquidity, usually around 10%. But that means if you deposit $10,000, they can lend out $9,000 immediately. Here's where it gets crazy though, pay close attention. When they lend out that $9,000, it gets deposited somewhere, and then that bank can lend out 90% of that. This creates a multiplier effect throughout the entire banking system that benefits them massively. Your original $10,000 deposit can create $90,000 or more in loans throughout the banking system. And every dollar that's loaned out is earning interest. Your single deposit generates interest income on 9 times its value. You're getting 0.4% on your $10,000. They're getting interest on potentially $90,000 in loans. And you're happy because your account still shows $10,000. It's financial alchemy, and you're being transformed into gold for someone else. Meet Sarah. She's 32, makes $65,000 per year, and she's been told her whole life to save money in the bank. So she has $25,000 in a savings account earning 0.5% annually. Sarah feels responsible. She's got an emergency fund. She's saving for a house down payment. She checks her account and feels secure seeing that $25,000. She's doing everything right according to conventional wisdom. But here's the reality. Sarah earns $125 per year in interest on her $25,000. That's $10.42 per month. Less than a Netflix subscription, and after taxes, she's netting maybe $90 per year. Meanwhile, her bank took that $25,000 and lent it out. Personal loan at 12%, $600 per year. Auto loan at 7%, $700 per year. Credit card at 22%, $1,760 per year. Total interest income from Sarah's deposit, $3,060 per year. Sarah got $125. The bank got $3,060. But it's actually worse because Sarah's $25,000 is losing purchasing power every year to inflation. At 3.5% inflation, she's losing $875 per year in real terms. So she's actually going backward by $750 per year after the interest they pay her. Over 10 years, this compounds into massive losses. Over 10 years, Sarah's $25,000 will grow to maybe $26,275 with compound interest at 0.5%. But with inflation, that $26,275 will only have the purchasing power of about $18,500 in today's dollars. Sarah just lost $6,500 in real wealth over 10 years by being safe and responsible with her savings. Meanwhile, the bank made over $30,000 in interest income from her deposits. Who's the winner here? Banks know this. They know inflation eats away at savings accounts. They know they're paying you far less than they're earning. So why do they push savings accounts so aggressively with massive advertising budgets? Because it's the most profitable product they have. They spend millions on advertising telling you to save more and build your emergency fund and earn competitive rates. But they never compare their rates to alternatives. They use psychological tricks to keep you there. First, they make it incredibly convenient. Your checking and savings accounts are linked. Transfer money with one click. It feels easy, so you don't look elsewhere. Second, they use the word savings, which sounds responsible and safe. Who doesn't want to be a saver? It's associated with being smart with money. They've branded getting ripped off as being financially prudent. Third, they advertise the percentage in a way that sounds better than it is. Earn up to 0.50% AP sounds like something. They don't say earn $50 per year on $10,000 while we earn $2,000. Fourth, they prey on fear. Your money is FDIC insured up to $250,000. That's true, but so are money market accounts, CDIS, and other alternatives that pay much better rates. They make you think savings accounts are the only safe option. Fifth, they create friction for moving money out. Try to transfer your money to a higher yield account at another institution, and suddenly, you have to verify identity, wait 3 to 5 business days, confirm via email. And sixth, they count on inertia. Most people opened their savings account years ago and never looked at the rate again. They just keep depositing money into the same account because it's what they've always done. Banks have literally built a business model around human psychology and financial ignorance. And it's working brilliantly. Trillions of dollars sitting in low-yield accounts while banks make record profits. It's genius and it's disgusting. Let me show you what your bank doesn't want you to know. There are alternatives to traditional savings accounts that are just as safe but pay dramatically more. And they're counting on you not knowing it. High-yield savings accounts from online banks currently pay anywhere from 4% to 5% AP. That's 10 times more than traditional banks. Same FDIC insurance, same safety, just way better returns. Why can online banks pay so much more? Because they don't have the overhead of physical branches, thousands of employees, and massive marketing budgets. They pass those savings directly to customers. Let's go back to Sarah with her $25,000. If she moved that to a high-yield savings account earning 4.5% instead of 0.5%, she'd earn $1,125 per year instead of $125. That's an extra $1,000 per year for doing literally nothing except opening an account. Over 10 years, at 4.5% compound interest, her $25,000 would grow to about $38,750. Compare that to $26,275 at 0.5%. That's a difference of $12,475. Sarah just made an extra $12,475 by spending 2 hours opening a new account. 2 hours of work for $12,475. That's over $6,000 per hour. But even high-yield savings accounts aren't the best option for all your money. Because even at 4.5%, you're barely keeping up with inflation. You're not losing as much, but you're not really building wealth. For money you don't need in the next 3 to 6 months, there are better options. Money market funds, short-term Treasury bills, certificates of deposit, even bonds for long-term savings, all low risk, all pay better. Right now, 6-month Treasury bills are yielding around 5%. They're backed by the US government, so they're essentially risk-free. You can buy them directly from treasurydirect.gov with no fees. bonds are inflation-protected savings bonds with a variable rate tied to inflation. When inflation is high, they pay more. They guarantee you won't lose purchasing power, right now paying over 5%. Certificates of deposit at online banks are paying 4.5% to 5.5% for 1-year terms. Your money is locked up for a year, but it's FDIC insured and you know exactly what you'll earn. Let me show you the exact strategy you should use for your cash instead of keeping it all in a traditional savings account. This is what financially savvy people do, and what banks don't want you to figure out. Step 1. Keep 1 to 2 months of expenses in your regular checking account for daily transactions and bills. This is your operational cash. It needs to be immediately accessible. The interest rate doesn't matter here. Step 2. Keep 3 to 6 months of expenses in a high-yield savings account at an online bank. This is your emergency fund. It needs to be accessible within a day or two, but doesn't need to be instant. Step 3. For any savings beyond your emergency fund that you'll need in 1 to 3 years, put it in short-term Treasury bills, CDs, or money market funds. These pay better than savings accounts and are just as safe. Step 3. For any savings beyond your emergency fund that you'll need in 1 to 3 years, put it in short-term Treasury bills, CDs, or money market funds. These pay better than savings accounts and are just as safe. Step 5. For money you won't need for 5+ years, invest it in low-cost index funds in a tax-advantaged account like an IRA or 401k. This is where you build real wealth. This is how you beat inflation. This strategy means you're earning appropriate returns for each bucket of money based on when you need it. You're not sacrificing returns for liquidity you don't need. And you're not taking unnecessary risk. Let me show you the difference this makes in real numbers. Let's say you have $50,000 total. Most people put all $50,000 in a savings account at 0.5%. After 10 years, they have $52,556. But if you allocate it strategically, $5,000 in checking at 0%, $20,000 in high-yield savings at 4.5%, $10,000 in CDs and Treasury bills at 5%, and $15,000 invested at a conservative 8% average. After 10 years, you have $71,450. Compare that to $52,556. That's a difference of $18,894. Same money, same risk level for the safe portions, but dramatically different results. Now, I know what some of you are thinking, but isn't it risky to move money out of my bank? No, it's actually risky to keep it there. Let me explain why this thinking is backwards. The FDIC insures bank deposits up to $250,000 per depositor per institution. That insurance applies to savings accounts, checking accounts, CDs, and money market deposit accounts at any FDIC bank. So moving your money from Chase paying 0.4% to Marcus by Goldman Sachs paying 4.5% doesn't change your safety at all. Same FDIC insurance, same $250,000 protection. You're just getting paid 11 times more. Here's what I want you to do right now, today, not tomorrow. First, Log into your bank account and check what interest rate you're actually earning on your savings. Write it down, be horrified by how low it is. Second, open a high-yield savings account at an online bank. This takes maybe 30 minutes. A lie. Marcus, American Express, Discover, Capital One 360. Compare rates and pick one. Just do it now. Your bank is not your friend. They're a business designed to maximize profit from your money. Stop volunteering to be poor. Stop letting your bank get rich off your money while you get nothing. Take action today.